Which strategy is best? For most everyday investors, the one that consistently stands out is...
I interview 2,000 people a year. The last 15 years, are probably 30,000 people, and I get to see all these different strategies that people have undertaken. It's really, what's the return after the sale cost and the interest costs and the purchase costs?
Building costs have basically gone up over 50%. So what that meant is that these properties, which we bought for maybe $200,000 or $300,000, to knock them down and rebuild these same type of assets today is an extra 50%. Is cash flow getting a property that grows a lot in value, I then do an equity release and I live off that cash flow, or I sell the property off for profit and live off that cash? Or am I just happy with my 5 or 10K that I actually get from this property? Good investing, whatever it is, whether it's in property, whether it's in business, whether it's in shares, it's navigating risk.
I think investing is going to be massive as houses keep going up and people have to grow their net worth to a level to be able to buy a house, and is the way to go.
At a $500,000 property in 8.5 years, it's going to be worth $1 million on average. I'm taking that $500,000 of profit. I'm going to use that growth to... Guys, welcome back to the No BS Property Investing Podcast, where we're here for part 2 of our property strategy session. The first segment was, we went through in such detail, went for quite a bit of time, that we got to the end of the recording and we said, hey, there's such great content in here. We want to make sure that it's really easy for our listeners to digest. So we've had to split it up over 2. So thanks for tuning in. And we're going to be, like I said, with myself and Mark again to unpack all of that information. So let's get into it. The next one we want to get into is positive or neutral cash flow properties. Have you got any of those laying around, Mark? Oh, I'll get that every day. Well, I'm looking for something that's positively geared.
Well, one of the ones growing up in Melbourne, I was spending 20 years in Melbourne. I'm now in Brisbane, but in Melbourne, Dalesford and Hepburn were probably the cash flow positive. It was the non-seasonal, short-term rental type structure. That was where all the cash flow positive properties were. But if you look back at some of the analytics, which you guys would have up until 5 or 6 years ago, Dalesford didn't do anything for about 10, 12 years in growth. So absolute yield play, people would pocket, 10, 15, 20 grand rather than spending 10 grand to run the property. And that's really all they got out of it. And to me, if you look back at those cash flow positive properties, it wasn't worth it.
Yeah.
Because they might have made 15K for 6 years. Okay, they made 90,000, but they didn't have a growth asset.
Yeah, and I think that's a big one for me. So when we talk about positive or neutral cash flow properties, in general, what we're talking about here, we're talking about properties that are probably 1 or 2 bedroom units, apartments, townhouses, just really small, where the value of the property is not super high. We might be talking about properties in prior years, 100,000 to 300,000, where a lot of these assets sat, and they were getting really good or decent rents. They weren't too far off the house rent. So then because the buying price is really cheap, you got really high yields. That yield is now either neutral or positively geared. And there are some providers out there, and this is not to poo-poo them in any way, but I guess their methodology is, let's buy as many of these type of properties as we can. Let's go buy 10 of them, 15 of them if we can afford to get that. And they'll be neutral or positively geared. We'll go buy them out in all these fancy structures, and that way we can keep buying and buying more. But firstly, you got to have the capital or equity behind you to run it. But also too, like you rightly touched on, Mark, in terms of, if you're making 5, 10, 15 grand on this one property, it's a lot of work. And in general, and I think this is really important for the listeners listening on, is that if we exclude the kind of COVID boom of what happened to building prices, because in general, if you go back over decades and decades, the cost of building goes up at about 2.5-3% per annum. Now, what happened during COVID, we had crazy shortage of supplies, materials, access went through the roof, labor costs went through the roof. So building costs have basically gone up over 50% in that short window of time. So what has meant is that these properties, which we bought for maybe $200,000 or $300,000, to knock them down and rebuild these same type of assets today is an extra 50%. So they've actually seen some growth, but it's an absolute outlier. So if we need to just understand in terms of, we can sit here and we could go, well, it's going to happen again. Well, I sincerely hope we don't have another global pandemic again, because it's unlikely we're going to see that crazy growth spike again. So for me, I'm with you, Mark. I would much rather be tied into assets that are going to achieve a lot of capital growth, because what's cash flow? Is cash flow getting a property that grows a lot in value, I then do an equity release and I live off that cash flow, or I sell the property off for profit and live off that cash? Or am I just happy with my 5 or 10K that I actually get from this property, which also then might come with crazy, these are the other things too, some of these cheap properties, if you get a really expensive bill, you got to replace the roofing or the stumping or something like that versus the value of the home. It's a really, really large percentage of the value. But I don't know if you have any thoughts on that.
Well, a lot of people are doing it because they think they're going to replace their income and they can leave their employment. Okay, so to get cash flow positive after all the expenses and the interest, I mean, there were 18 rate changes. Okay, going back over the last 3 years, and I think rates have gone up 18 times, equivalent to 18. I think it was 14, but equivalent to 18.25. It's come back 3 times, so it's still 15 times up where it was. So all those people out there were chasing an income to buy multiple of these properties to replace their job. All of a sudden, within 3 years, their properties weren't making much money at all.
Yeah.
It's a risky play to go down that path, but a lot of people come out of these various investment seminars, et cetera, and say, I want to replace my income. I want to leave the job. I'm just going to become a property investor. I'm going to have 5 or 6 properties. I want a passive income off those properties. Very difficult and a lot of work to get to that stage. And for every, you say 1 in 10, Julian, I would say 1 in 40 people pull that off.
Yeah, absolutely. You need to be. It's a very, very sophisticated model to run, and there's a lot of risk you take on. I think good investing, whatever it is, whether it's in property, whether it's in business, whether it's in shares, it's navigating risk, because the more you leave the door open to risk, the more chances you're going to run into that. So it's a big one. And I guess the next one we want to get into, though, and this one's obviously, I'd say it's probably not as popular in recent times, but I have seen it's making a bit of a resurgence, is the renovate and flip. So that's, buying an old property, doing a cosmetic renovation or maybe a major renovation. Obviously, there's obviously different scales to it as well. And then, some people will just sell the property off for profit, use that. Others might want to utilize that to extract equity. I guess here in the from the buyer's agent's perspective, representing Ripehouse Advisory, it is a model that we, I guess, entertained on a large portion of our homes in the early days of the buyer's agency business, where we'd buy older homes, we'd do up the kitchens and bathrooms, and we'd get a bit of an uplift. I guess the goal was then you spend $1, you make $2 or $2.50. But I guess what we've kind of found is that, cost of construction, cost of labor went up so much that return didn't really come through. And because vacancy rates are so tight now, the renovated versus the unrenovated property, back then you used to get an extra $100 a week because your property was renovated. Now you might only get an extra 20 or 30. So it's weighing up that return. I guess from the lending perspective, Mark, is that still an appetite for people out there, or I guess any things that people should be aware of trying to go down that model?
Used to be massive, Julian, 15 years ago. It was really big in Melbourne. A lot of people would buy apartments for 250 grand, go and spend 40 on it, sell it for 370 and make 50K, 60K after costs. And that was a regular thing. But then the apartment market in Melbourne hasn't gone up since under 70 square metres since February 2010. So obviously that can't happen. So it's very rare to see it now, but my advice is, and from the people that come and see us, unless you've done it a lot and know what you're doing, okay, and then a lot of my customers will go to these seminars that run these renovation shows to buy and sell and flip. And I interview 2,000 people a year. For the last 15 years, there are probably 30,000 people, and I get to see all these different experiences and strategies that people have undertaken. And it's very, very rare that you see that these come off consistently. Because by the time, like you said, you're taking purchase costs, sale costs, running costs, renovation costs, and then if the yield's not going up, and the yield's it's really not that important because you're flipping.
Yeah.
Okay. So the rent's not the important part. It's really what's the return after the sale costs and the interest costs and the purchase costs. So if you bought something today say you bought something for $750, okay, in a bit of a rundown place in Melbourne, and it costs you $50 to get in. If you use the buyer's advocate, it's cost you about $70K to get in. It's going to cost you $25 to $30 to sell it. You might spend $150 on it. You're going to have to go and sell it for one over a period of time to be really worth anything substantial to you. So you'll find that when you do all those numbers, the margins might only be 20 to 50K, which is quite the risk to take on for a period of time that might take you 6 to 12 months to get in and get out of the market.
It's a lot of work, what I find, and having somebody who's been and done it firsthand themselves. I think that the first one I did, I basically took a break from ever even considering just even doing a bit of paint for the next 2 or 3 years. It's a bit of a burnout. I think the thing that I say to most people is understanding that time aspect, right? So the ones that I see it be most successful for, hands-on investors. It's not really suited to people who want a passive investment, because if you're going to be a hands-on investor, you're probably already a trade or you're very kind of savvy on the tools yourself as well. And you'll potentially make some gains there. Because if you're going to keep contracting in all these people to do the work, in general, they're not working for free. They've got to make a margin. They're going to have to get all that stuff. Unless you're project managing it, you still might make a little bit, but it's a lot of time and effort. From my experience and what I've seen with other clients, I think a lot of people would be better off doubling down on whatever it is that they do for an income generation. So let's just say you actually are a tradesman. Go out there and chase extra jobs. Like if you are going to spend your Saturdays and Sundays renovating your place, could you potentially do side work, whether it's on Airtasker or through your actual business that you're actually making money? Because I think when I look at it that way, well, one, it's guaranteed money in hand, right? It's not a risk where I'm going to try and get this property up to scratch on the market and then maybe the market sees the value in my work and I get it's guaranteed money. But also, I guess, from the lending market, and maybe you can comment on this as well, if I can increase my income by 10, 20, 30, 40, 50,000 a year, from a lending perspective, does that actually help me a lot more moving forward than what, the extra 30K or 50K profit I make at the sale? If you're serious about building wealth through property, you don't just need a loan, you need a strategy. And that's exactly what the Australian Lending and Investment Centre delivers. Australia's most awarded brokerage. They're not just looking at what you can borrow, they'll build you a holistic lending plan tailored to your long-term goals. We use them, we trust them, and so do our clients. So to find out more or to book your complimentary lending strategy session, head to the link in the show notes to connect with the team. Thanks for listening. Now back to the video.
Definitely. And if you don't do it regularly and it's not part of your profession and it's not documented on your tax return, then banks can't use that income moving forward anyhow. So it's kind of a once-off anyhow. But 30 or 40K of extra income, what you're talking about there, Julian, from your current employment or a similar employment to what you're doing on a full-time basis is going to increase your borrowing power by about 700 to 800K, depending on the rental yield on that asset. So that's where you get the capacity from. But what I see is a lot of people come in for these types of transactions and they haven't done the numbers.
Yeah.
Well, they don't understand the numbers. If you don't understand the numbers and what the exact return is at the end, building in buffers and risks and different types of things that can go wrong in that project, it might take an extra 3 months to get approval through. It might take an extra 3 months to sell the asset, and rates might go up 4 times, et cetera, et cetera. And no one knows the numbers. And I can tell you 9 out of 10 people that come in to talk about these types of transactions, we've killed it off within 20 minutes because I've done the numbers in front of them and it doesn't make sense.
I get the exact same thing on the subdivision, the subdivision side of things, where it's like you've got a $700,000 asset and someone's like, well, I could subdivide the back. And I'm like, well, yeah, what's it going to cost you to build it? It's going to cost this. And then what's it going to do to the value of the front property? It's going to bring it down to this. And it's like, guys, it's just not going to make you the money. I think I'd say of all the strategies we go through today, it's probably other than the last one I'm saving for the end, it's probably the one that you do technically take on the least amount of risk, depending obviously on the scope. If you're going to go knocking down walls, council approvals, if you're doing just a general cosmetic flip, I guess your risk exposure is not as great. But again, it's just at that time piece, I think, is really, really critical.
Yeah, and look, everyone underestimates the work that it takes and the time you've got to put in. Okay, so if you actually build your actual hourly rate into it as well,
yep,
and that's what people should do, it actually brings that profit margin down even further. So in most of those cases, very, very rarely do we see something. I had one a couple of days ago where a client bought a property in Perth, through a buyer's advocate, bought it 3 years ago, paid $640 for it, and subdivided the back block off. Now, it cost him $80,000 for a subdivision, and the subdivision took a year to get through. Okay, so the cost and all that. Now, it was worthwhile in the end because we sold the back block for $515K. The house has gone up. It's a growing market. We bought low on the market. It's a perfect buy. And in the end, it's an amazing transaction. But the work he put into it and the time he put into it was phenomenal in that year to try and navigate that. So to me personally, if I'm going to subdivide, I'd be paying someone to do it, to do that work, to get in there and do it. But the cost to subdivide is normally 40 to 80K to process that transaction.
Yeah, and I think you touched on it there. In my experience as well, when I've seen people who have done great on a reno flip or a subdivision, they've normally done it in a market that's rising anyway. So if they actually just park their money in a set and forget type of property in that same location, that the difference is they just probably would have had an extra 20 hours of up their sleeve each week instead of pouring that into the property, which I think for most people it's going to be the big one. And now the last thing I want to get into is, I guess, this is the buy and hold strategy. So when I say buy and hold, I'm talking about we're buying it, we're holding it. We're not holding it indefinitely. It could be forever, but it could be for 5 years. But we're really focusing on capital growth, and we're okay to absorb some negative gearing. I think it's understandable at the moment. Interest rates kind of, in most cases, high fives, early sixes. Rental income on a residential property is going to be somewhere in the fours or fives in general, threes if you're going in high price properties. You're not going to be making money on these properties from a cash flow perspective. You're going to be relying on some negative gearing, potentially some depreciation to hold and withstand that property. But the reason you're buying the property is, I guess, you're buying into an area that you feel that there's value, you're going to see capital growth, and that's going to really where you make your market. I guess from your perspective, Mark, like how do banks, in going through the other properties that we've bought, is this the safest option for the bank? Like, do they see these ones as the easiest to work with, or does it, just the typical buy and hold? Like, how does that, I guess, the risks and how do the banks view this?
Banks are more open to it now. So if you wind it back 10 years ago, a lot of banks wouldn't have been really proactive on investment lending structures. And I would always say 10, 15 years ago when we set up our LIC is that we're going to take you to an investment lending bank. So a bank that really understands leverage, tax, gearing, who's going to be there with you for the next journey to buy the second, the third, the fourth property. Not a smaller bank like a second tier. A second tier might be like a Suncorp, an AMP, First Mac, those types of institutions that basically aren't massively big on you investing and leveraging and buying multiple assets. They're more of a transactional bank. Here's your home loan. If you get your home loan, they want you to be a home loan customer for 30 years. They're not really a leverage type bank.
Yeah.
So the banks are changing in that regard and they're becoming more investment oriented, and which is good. Do they all use negative gearing and understand it? No, they don't. Okay, so you can get higher capacities through certain banks with negative gearing, and then some treat trusts with negative gearing, some don't. Some don't even deal with trusts at all. So there's all these different levels of banks out there from a gearing and investment perspective. And that's why we set up our LIC originally, was to really understand and get the right bank fitted to the right people with their right risk profile with what they're trying to achieve. That's one of our aims. And we believe we know the bank system very, very well, who does what and when. But it's interesting, the average person out there believes all banks are the same, and they're all quite the opposite.
Yeah. Would you say, though, of all of them, like, so all the strategies we went through, we went through the share homes, the commercial property, the neutral positive cash flow, the Renovate Flip, the just the standard buy and hold. Would that be the most common one the banks are more receptive to work with, and I guess what most clients are out there purchasing day to day? Like, I guess, would you say if I go to the average broker or accountant and then I have to almost give them an explainer what an NDIS home is or a share home is that fair to assume?
Yeah, it is. And like I said just before, banks are more au fait with it now from the investment level, and they feel safer with it, the majority of them. But a lot of them still don't love it. It's not their primary thing. I think they need to adapt and change pretty quickly. I think rent vesting is going to be massive as houses keep going up and people have to rent vest to grow their net worth to a level to be able to buy a house, and rent vesting is the way to go. So I think they will change drastically, and it's a space that is going to evolve significantly. So to answer your question, yes, the banks are more comfortable with it. They do like the more basic transaction. They do want the residential property. They don't want the one that's out in regional XYZ, zoned XYZ, that's different, that's outside the box.
Tiny mining town in the middle of nowhere, population of 5,000 people. They don't want those ones, do they?
No, they don't, and they can pick and choose which ones they want, depending on their policies that they've set up within the bank system. Even to apartments, they'll only take a certain number of apartments in a certain building or a certain location. Melbourne CBD was on the nose there for a long time, and it should have been, because all the analytics said it wasn't going to go up, and it hasn't gone up for 15 years.
Yeah.
So they don't want exposure in those particular buildings, or too much exposure in Melbourne, because it actually brings the bank to an element of risk. So banks are, to answer your question, the banks are open to investment, but will be selective about what they go into. And then when you borrow above 80%, that brings another element to it, Julian, where a lot of banks won't go to certain asset classes or postcodes, which you found out at Ripehouse. There's certain postcodes that they won't go above 80% to in like regional Victoria and various places.
Yeah, absolutely. I guess the reason most people are going down that buy and hold strategy and focusing on capital growth, and why we as a business are big advocates for it, and I guess myself personally, I'm a big advocate for it, is in terms of the average 3 or 4 bedroom home in Melbourne and Sydney over the last 6 decades has doubled in value every 8.5 years. So if I was to tell you, you go out there today and for the last 6 decades, you had a $500,000 property in 8.5 years, it's going to be worth $1 million on average. Obviously, the thing is with markets, they move up and down. It's not like this nice linear line. But if you're going to make that $500,000 profit over 8.5 years, I'm taking that $500,000 of profit over my $5,000, $10,000, $15,000 of passive income over that 8.5 year period every single day of the week. And what that allows me to do as an investor, it obviously depends on my circumstances, but am I going to use that growth to pay off my mortgage much quicker? And instead of being a slave to my mortgage for the next 20 to 30 years, I'm done with it or 5 and 10. Am I going to use that to actually buy my first home? So you talked about, rent vesting. Is it going to allow me to go from having barely any deposit, and I've had mum and dad come in as guarantor, and I've made a couple of $100,000 myself. Now I can go buy my house, and then I can focus on paying off my mortgage? Yep. Or is it going to allow me to just go from one property to the next? So for me, I'm very, very big. I think it suits most people as well because it's a very hands-off investment. Most people, when they're getting into investing, they're doing it as a partnership. It's boyfriend and girlfriend, husband and wife, whatever partnerships you're in. There's a lot of the time it's 2 people involved, sometimes even more. And it's probably the strategy that suits most people. So that's why I'm a big advocate for it. But thanks for having you here again with us here today, Mark. So in conclusion, which strategy is best? The truth is they can all work. But for most everyday investors, the one that consistently stands out is buy and hold capital growth investing. It's not about quick wins or tax tricks. It's about buying quality property in the right location, holding it, and letting time and growth do the heavy lifting. That's the approach we focus on because it builds real wealth in the long term. So the takeaway, don't copy someone else's strategy. Pick the one that actually matches your goals, your lifestyle, and your stage of life. And for most people, that means buy and hold. Thanks for listening today, and we will catch you on the next episode. Thanks for watching. If you want to see some high-performing suburbs, then grab our free Suburb Performance Report below. It's packed with data we use every day to guide our clients.